Welcome back, future CPAs. This is part 2 of our series, Performing Further Procedures and Obtaining Evidence, which covers the third area of the Auditing and Attestation section. If you're new here, don't forget to hit subscribe and share this with your fellow CPA candidates who are looking for quality review materials for free. This program is built to help you learn more efficiently in less time. We start with multiple choice questions as the foundation, then zoom out to connect them with key topics and align everything with the AICPA exam's representative tasks. The visuals are kept minimal on purpose, so you can also treat this like an audiobook, perfect for maximizing your study time on the go. Wishing you the best on your CPA journey. All right, question. An auditor is evaluating evidence for a complex estimate, such as a pension obligation and related plan assets. Which statements describe appropriate sources of sufficient appropriate evidence? Let's go through them. Statement 1. Review the work of management's actuary after evaluating the actuary's competence, capabilities, and objectivity, and test significant inputs back to source systems where relevant. Yes, reviewing management's actuary is fine, but only after assessing the actuary's competence, capabilities, and objectivity, the 3 C's. We don't just rubber stamp their work, we also trace significant inputs back to source systems to check for accuracy. Statement 2. Obtain independent market data such as discount curves, mortality tables, and pricing for plan assets from reputable external providers as of the measurement date and corroborate critical inputs. Yes, independent, reputable market data is highly reliable. Using external discount rates, mortality tables, or pricing for plan assets helps corroborate management's inputs. This boosts both sufficiency and appropriateness of evidence. Statement 3. Develop auditor-generated evidence by engaging an auditor-hired actuary or valuation specialist, or by independently recalculating the liability using tested internal data and relevant external data. Yes, auditor-generated evidence, whether by hiring our own actuary or recalculating the liability ourselves, is extremely strong evidence. It combines tested internal inputs with relevant external data, giving us independence and reliability. Statement 4. Use industry average discount rates from a general business publication to corroborate a tailored plan's discount rate. No, generic industry averages don't meet the bar. They lack relevance because pension discount rates must reflect the specific characteristics of the plan. Using a broad average would be like using the average shoe size in America to order shoes for your audit team. Someone's gonna walk funny. So the correct statements are 1, 2, and 3. That makes the right answer option C. This question directly connects to the exam blueprint representative task. Determine the sources of sufficient appropriate evidence, for example, obtained from management specialists, obtained from external sources, developed by the audit team from internal or external sources. Let's break it down. 1. Evidence obtained from management specialists. Example, management's actuary for pension obligations. The auditor must evaluate competence, capabilities, and objectivity before relying on their work. Testing significant inputs like employee census data, payroll contributions, or plan assumptions back to source systems ensures accuracy. This is valid, but only after skepticism and verification. 2. Evidence obtained from external sources. Example, discount rate curves, mortality assumptions, fair value pricing for plan assets. Independent, reputable sources increase reliability, especially when dated as of the measurement date. External corroboration addresses risks of management bias. 3. Evidence developed by the audit team using internal and external data. Example, engaging the auditor's own valuation specialist or recalculating the liability using tested plan data combined with external benchmarks. Auditor-developed evidence is generally the strongest form because it reduces dependence on management. It also allows the auditor to evaluate the sensitivity of assumptions and test reasonableness. The key standard here is AUC 500. The reliability of evidence depends on its source and nature, and on whether it's obtained directly by the auditor. External evidence is more reliable than internal. Auditor-generated evidence is more reliable than management-provided. Evidence from a competent, objective specialist can be persuasive, but only after proper evaluation. What doesn't qualify? Generic, high-level averages that don't reflect the entity's specific facts and circumstances. That's insufficient and inappropriate evidence under AUC 540, Auditing Accounting Estimates. So, in summary, management's actuary? Fine, but check their credentials before you let them drive the audit bus. Independent market data? Yes, that's the GPS. Auditor-generated evidence? Best of all, you're in the driver's seat. Industry averages? That's like saying the average student studies 200 hours for the CPA exam, so you'll be fine if you do the same. We both know it doesn't work that way. On exam day, remember, relevance plus reliability equals sufficient, appropriate evidence. All right, next question. An auditor is evaluating evidence for inventory at year-end. Which actions best reflect the proper application of professional skepticism and professional judgment? All right, let's break this down statement by statement. Statement 1. Compare quantities from the client's year-end inventory listing to third-party warehouse receipts and investigate discrepancies. Yes, that's exactly the kind of thing we should be doing. Don't just take management's listing at face value. Tie it back to independent external documentation. And if the numbers don't match, dig in. That's skepticism in action. Statement 2. Evaluate management's analysis of consignment inventory and check it against the actual agreements. Then test a sample for rights and obligations. Absolutely. Just because inventory is sitting in a warehouse doesn't mean it belongs to the client. Professional judgment here means checking. Whose inventory is it really? We don't want to count goods that aren't ours to count. Statement 3. Inspect items during the physical count to verify their condition, especially looking for obsolescence. Yes, again. Inventory valuation isn't just about quantity, it's about condition. If you see dusty boxes of floppy disks in the corner, you're not going to value those at full cost. Skepticism means asking, can this still be sold at normal prices, or is it impaired? Statement 4. Conclude that reliance on internally generated inventory reports is sufficient because they reconcile to the general ledger. No, big red flag. Reconciliation to the ledger only shows consistency within management's system. It doesn't tell us if the numbers are real, complete, or properly valued. That's the trap answer. It ignores external corroboration and physical evidence. So the best set of statements is 1, 2, and 3. That makes the correct answer option A. This ties directly to the blueprint task. Exercise professional skepticism and professional judgment while analyzing information to be used as audit evidence, taking into account its relevance and reliability, authenticity, and whether such information corroborates or contradicts the assertions in the financial statements. Here's how. Relevance and reliability. Third-party warehouse receipts, Statement 1, are more reliable than internal records. Consignment agreements, Statement 2, are relevant to rights and obligations. Physical inspection, Statement 3, is highly relevant to valuation. Sole reliance on internal reports, Statement 4, lacks reliability. It's management talking to itself. Authenticity. Authentic evidence can be traced to independent sources or directly observed by the auditor. Warehouse receipts and physical inspections pass this test. Internally generated reports without external corroboration do not. Corroboration versus contradiction. Skepticism means asking, does this evidence confirm what management says, or does it raise new questions? A discrepancy between warehouse receipts and inventory listings doesn't confirm, it contradicts. And it's our job to chase that down. Professional skepticism is about staying alert for those contradictions, not blindly accepting smooth reconciliations. So here's the lesson. Third-party confirmations? Yes. Consignment agreements? Yes. Physical inspections? Yes. Blind trust in internal reports? Absolutely not. Remember, auditors aren't supposed to be cheerleaders. We're supposed to be referees. If management says, don't worry, the numbers reconcile to the ledger, our job is to say, great, now let's see the receipts. And if you ever see an answer choice on the exam that basically says, just trust management because the books tie, that's the candy-coated trap. Looks sweet, but you'll regret it later. All right, next question. An auditor is designing procedures to test revenue transactions in a population of several million invoices. Which statements best reflect the appropriate purpose and application of sampling techniques, including the use of automated tools? Let's go statement by statement. Statement 1. Sampling allows the auditor to draw conclusions about a population efficiently instead of looking at every transaction. Absolutely true. If you've got millions of invoices, you're not going to check them one by one unless you want to live in that audit room forever. Sampling is about efficiency, testing a subset to reach conclusions about the whole. Statement 2. Automated tools can stratify the population by characteristics, for example, transaction size or date, which improves representativeness. Yes, this is a great way to make samples more precise. Stratification means you divide the population into groups that matter for audit risk. That way, the sample better reflects the entire population. Automated tools are perfect for this job. Statement 3. Selecting only high-value items above a threshold is sufficient for sampling because testing large transactions ensures population-level conclusions. Nope, that's a classic trap. Testing big-dollar items is important. We call that targeted testing, but it's not enough for drawing conclusions about the entire population. Small transactions can still add up, and they can still be misstated. This statement confuses judgmental selection with actual sampling. Statement 4. Exception reports generated through audit data analytics can highlight unusual items, which the auditor may test separately in addition to a representative sample. Yes, that's spot on. Data analytics help us identify outliers, spikes, or odd patterns. We can then test those separately while still relying on a representative sample for conclusions about the full population. So, the correct set is statements 1, 2, and 4. That makes the best answer option B. This ties directly to the exam blueprint representative task. Understand the purpose and application of sampling techniques, including the use of automated tools and audit data analytics to identify significant events or transactions that may impact the financial statements. Sampling's purpose: efficiency and representativeness. We use smaller sets of data to draw valid conclusions about big populations. Automated tools. They improve the process by stratifying populations, randomizing selections, and generating exception reports. They take the grunt work out of population analysis. Judgmental selection versus sampling. High-value testing alone doesn't qualify as sampling. It helps with materiality, but it doesn't let you generalize to the population. Exception-focused testing. ADA lets us zoom in on the weird stuff, unusual spikes, duplicates, odd timing, and test those separately. But that's in addition to, not instead of, representative sampling. So professional judgment means combining these approaches: representative samples for conclusions, targeted tests for unusual items, and automated tools to make it all more effective. Here's the big lesson. Sampling is your shortcut to the truth. Automated tools are the GPS. Exception reports are the, that looks suspicious moment. And testing only the big items, that's like checking only the biggest slices of pizza to see if the whole pie is cooked. Looks fine on top, but you might miss the soggy middle. On exam day, if you see just test the large items as the answer, that's the candy-coated trap. Looks right, but it's missing the bigger picture. Next question. An auditor is designing substantive procedures for revenue. Which populations of items are most appropriate for the stated objectives? Let's walk through each statement. Statement 1. Testing occurrence of revenue by selecting entries from the sales journal and vouching them back to shipping documents. Yes, the occurrence assertion asks, did these recorded sales actually happen? To test that, you start with what's recorded, the sales journal, and vouch it back to source evidence, like shipping documents. This confirms the sales were real, not fictitious. Statement 2. Testing completeness of revenue by selecting purchase orders near year-end and tracing them forward to the sales journal. Careful here. Completeness asks, are all sales that should be recorded actually recorded? To test it, you usually start with source documents, like shipping documents, bills of lading, or customer orders, and trace forward to the sales journal. Purchase orders, though, don't prove a sale has occurred. A purchase order is just a request. Without shipping or invoicing, it doesn't create revenue. So this statement doesn't hit the completeness assertion correctly. Statement 3. Testing existence of accounts receivable by selecting balances from the AR aging schedule and confirming them with customers. Yes, existence means, do these receivables actually exist at year-end? Confirmations directly with customers provide strong external evidence. If a customer says, yes, I owe you $10,000, that's persuasive evidence of existence. Statement 4. Testing valuation of accounts receivable by selecting balances from the AR aging schedule and evaluating collectability using subsequent cash receipts. Yes, again. Valuation means, are receivables stated at their net realizable value? Looking at subsequent cash receipts is the gold standard for evaluating collectability. If the customer pays in January, you know that December balance was good. If not, maybe it needs an allowance. So the best statements are 1, 3, and 4. That makes the correct answer option A. This connects directly to the representative task in the exam blueprint. Design substantive procedures that address relevant assertions for classes of transactions, account balances, and disclosures. Occurrence of revenue, statement 1. Start with the recorded sales and vouch back to shipping docs or bills of lading. Goal, prove the sales actually happened. Completeness of revenue. Properly done, start with source docs, for example, shipping documents, and trace forward to ensure they're recorded. Using purchase orders doesn't establish completeness because a PO is not yet revenue. Existence of AR, statement 3. Start with the recorded balances in the AR aging and confirm directly with customers. External confirmations equal highly reliable evidence. Valuation of AR, statement 4. Use the AR, a subsequent cash receipts, and other evidence to assess collectability and adequacy of the allowance. This is exactly what the standards AUC 330, AUC 500, and AUC 505 and the blueprint expect, matching the right population to the right assertion and choosing evidence that is relevant and reliable. So here's the takeaway. For occurrence, start with the books and go backward. For completeness, start with source docs and go forward. For existence, confirm it with the customer. For valuation, follow the money. And if the exam ever tempts you with a purchase order to test completeness, remember, a purchase order is basically a wish list. Until the goods are shipped, it's not revenue. It's just the customer saying, pretty please. Okay, next question. An auditor is determining the appropriate sampling method for various audit objectives. Which of the following pairings are correct? Let's check each one carefully. Statement 1. Testing the operating effectiveness of a control, like approvals on purchase orders, using attribute sampling to estimate the rate of control deviations. Yes, that's right. Attribute sampling is designed for yes-no questions. Did the control work or did it fail? It's exactly what we use for controls testing. Statement 2. Testing occurrence of revenue transactions for overstatement risk using monetary unit sampling to focus on larger dollar recorded items. Correct again. Monetary unit sampling, sometimes called probability proportional to size sampling, gives bigger dollar items a higher chance of selection. That makes sense for testing overstatement, because fake or inflated sales usually show up in recorded transactions, and often in big dollar ones. Statement 3. Testing valuation of accounts receivable through subsequent collections using attribute sampling to estimate misstatement amounts. No, that's the mismatch. Valuation is about amounts, not yes-no control effectiveness. For AR valuation, we care about how much is collectible. Attribute sampling isn't designed to estimate dollars of misstatement. It's for deviation rates. This one is wrong. Statement 4. Estimating the total misstatement and inventory balances using variable sampling to project sample results to the population. Yes, variable sampling is designed to estimate dollar misstatements and then project them to the population. Exactly what you'd want for inventory. So, the correct set is statements 1, 2, and 4. That makes the best answer option B. This ties directly to the exam blueprint representative task. Understand the purpose and application of sampling techniques, including the use of automated tools and audit data analytics to identify significant events or transactions. Attribute sampling used to test controls and rates of deviation. Statement 1. Monetary unit sampling, a form of variable sampling that focuses on dollar misstatements and emphasizes larger amounts. Useful for occurrence or overstatement testing. Statement 2. Variable sampling used to estimate or project misstatements and account balances. Statement 4. Mismatch trap using attribute sampling for valuation of AR is wrong because valuation needs dollar-based methods, not yes-no testing. The key is to always align the sampling method with the assertion and the objective. Controls, attribute sampling. Transactions/overstatements, MUS. Balances/valuation, variable sampling. So remember, attribute sampling is your yes-no guy. Was the control working or not? Monetary unit sampling is your big spender. Let's chase the big dollar items for overstatement risk. Variable sampling is your math nerd. Let's crunch the numbers and project misstatements. And if anyone tries to use attribute sampling for AR valuation, that's like bringing a calculator to a spelling bee. Wrong tool, wrong place. You might also hear about things like haphazard, block, or systematic sampling in practice. Those exist, but for exam purposes, the focus is on attribute, variables, and monetary unit sampling. Next question. An auditor tests a sample of 100 invoices from a population of 10,000 sales invoices. The sample reveals $5,000 in total overstatements. Which conclusions are most appropriate? Let's break this down. Statement 1. The projected misstatement to the population is approximately $500,000. $5,000 divided by 100 times 10,000. The projected misstatement is about $500,000. Now, the math looks fine. $5,000 in errors divided by 100 invoices gives $50 average per invoice. Multiplied by 10,000 invoices equals $500,000. But projection isn't that simple. The standards, AUC 530, require that projection be consistent with the sampling method and that it be evaluated together with sampling risk. Stating $500,000 as the conclusion is incomplete. Statement 2. Sampling risk means the actual population misstatement may be higher or lower than the projection, so the auditor must calculate an allowance for sampling risk. Sampling risk means that actual misstatement could be higher or lower than the projection, so we calculate an allowance for sampling risk. Exactly right. This is what protects us from blindly relying on the projection alone. Statement 3. Because the projection exceeds tolerable misstatement, the auditor must always require management to adjust the financial statements for $500,000. Because the projection exceeds tolerable misstatement, the auditor must always require a $500,000 adjustment. Wrong. There's no always. The next step is to evaluate projection plus allowance for sampling risk against materiality. Only then do you decide whether more testing, expanded samples, or adjustments are required. Statement 4. The auditor should compare the projected misstatement plus allowance for sampling risk to overall and performance materiality to decide the appropriate audit response. The auditor should compare the projected misstatement plus allowance for sampling risk to overall and performance materiality to decide the audit response. Yes, this is exactly the evaluation step the standards require. So the most appropriate conclusions are Statement 2 and Statement 4. That makes the correct answer option B. This fits directly with the exam blueprint representative task. Use sampling techniques to extrapolate the characteristics of a population from a sample of items. Here's how it applies. Extrapolation from the sample. The $500,000 projection is an example of extrapolating the misstatement rate from the sample to the population. That's the extrapolate characteristics part. Sampling risk. Extrapolation alone isn't enough. The auditor must recognize that the true population misstatement could differ. That's why AUC 530 requires calculating an allowance for sampling risk. Evaluating against materiality. The auditor doesn't stop with the projection. The right move is to take the projection plus the allowance and then compare the tolerable misstatement and performance materiality. That's how sampling results translate into audit conclusions. Professional judgment. If the projected misstatement plus allowance exceeds tolerable misstatement, the auditor may expand testing, perform additional procedures, or propose adjustments. If it falls below, the evidence may be sufficient. The judgment is based on the full evaluation, not just the raw projection. So the key lesson, sampling techniques help us extend what we learned from 100 invoices to the whole population of 10,000. But the extrapolation is just one step. Proper audit conclusions require accounting for uncertainty and materiality. Think of it this way. You taste one French fry from the bag. If it's salty, you might assume the whole batch is salty. That's your projection. But maybe you got the one fry with extra salt. That's sampling risk. The allowance is your margin for that possibility. And materiality? That's you deciding if it's too salty to eat or still good enough for lunch. The CPA exam wants you to remember projection plus allowance, then materiality. Never stop at the first fry. All right, next question. An auditor is planning substantive and controlled testing for payroll. Which of the following procedures are appropriately matched to the described audit evidence gathering techniques? Let's break them down. Statement 1. The auditor attends the client's physical inventory count to watch staff perform counts and compare selected tags to recorded quantities. Observation and inspection. This is the classic inventory count procedure, watching client staff perform counts, observation, and comparing tags to recorded amounts, inspection. The matching is correct. Observation equals watching others do the work, and inspection equals looking at documents or assets yourself. Statement 2. The auditor independently recomputes gross to net pay for a sample of employees using both system extracts and tax tables. Recalculation. Independently recomputing payroll calculations. That's textbook recalculation. Checking the math accuracy of documents or records. Here, the auditor uses tax tables and extracts to recompute gross to net pay. Spot on. Statement 3. The auditor reperforms the client's monthly bank reconciliation by preparing it from bank statements and the GL cash account. Reperformance. Reperforming the client's bank reconciliation. That's exactly what reperformance is. The auditor independently executes the client's procedure to test its operating effectiveness. Correct match. Statement 4. The auditor asks the payroll manager whether all terminated employees were removed from the payroll master file and, based on the response, concludes controls are effective. Inquiry. Inquiry. Asking the payroll manager about terminated employees. Yes, that's inquiry. But the second part is the problem. Concluding controls are effective based only on inquiry. AUC 500 is clear. Inquiry alone is rarely sufficient audit evidence. We need corroboration. So the matching is technically correct for inquiry, but the conclusion step is inappropriate. So the properly matched ones are 1, 2, and 3. That makes the correct answer option A. This links directly to the exam blueprint representative task. Evaluate the relevance and reliability of different audit evidence gathering techniques when planning and performing procedures. Observation and inspection, statement 1. Observation lets you see how processes are carried out, while inspection gives you direct evidence from documents or assets. Reliable, but observation alone is limited because people behave differently when watched. Recalculation, statement 2, provides very reliable evidence because the auditor is independently verifying mathematical accuracy. Reperformance, statement 3, also highly reliable because the auditor independently executes the procedure, like redoing the reconciliation. Inquiry, statement 4, useful for gathering information, but weak on its own. Standards are clear. Inquiry must be corroborated by other evidence. The blueprint wants you to recognize that not all evidence-gathering techniques are equal. External, independent, or auditor-generated evidence is more reliable than internal management representations. So, remember, observation is like watching a cooking show. Inspection is tasting the food yourself. Recalculation is checking the recipe math. Reperformance is cooking the dish yourself. Inquiry? That's just asking the chef if it tastes good. Would you really trust only their answer? On exam day, if you see concluding based only on inquiry, that's the candy-coated trap. Looks sweet, but it's not sufficient. Okay, next question. During planning, an auditor interviews both the CFO and a warehouse supervisor about year-end inventory. Which of the following actions best demonstrate appropriate analysis of responses and effective follow-up? Statement 1. When the CFO explains that inventory quantities are always reliable because staff are well-trained, the auditor follows up by asking how differences between physical counts and records are investigated. Yes, the CFO's always reliable answer is a red flag for an auditor with professional skepticism. Staff training alone doesn't guarantee accuracy. Following up by asking about how differences between counts and records are investigated is exactly what an auditor should do. Statement 2. When the warehouse supervisor mentions frequent shipment delays in December, the auditor asks whether any goods in transit at year-end were recorded as sales and requests documentation. Yes, again. Shipment delays near year-end are a risk factor for cutoff errors. Asking if goods in transit were recorded as sales and requesting documentation is textbook skeptical follow-up. Statement 3. When the CFO describes the valuation method as FIFO, the auditor notes the response but does not ask further questions because the policy is GAAP permissible. Nope. FIFO is GAAP permissible, sure, but that doesn't mean you stop asking questions. The auditor still needs to understand how FIFO is applied, whether it's consistent year to year, and whether it's appropriate given the client's inventory. Simply accepting it's FIFO is not enough. Statement 4. When staff mention new handheld scanners for counts, the auditor asks how exceptions flagged by the devices are reviewed and whether prior issues were resolved. Yes, new handheld scanners sound promising, but auditors don't assume technology equals flawless. Asking how exceptions flagged by scanners are reviewed and whether earlier issues were resolved shows professional skepticism and effective follow-up. So the correct set is statements 1, 2, and 4. That makes the right answer option C. This connects directly to the exam blueprint representative task. Exercise professional skepticism and professional judgment while analyzing information to be used as audit evidence, taking into account its relevance, reliability, authenticity, and whether it corroborates or contradicts management's assertions. Skepticism means not accepting vague assurances. Training is good, but you need to know how exceptions are handled. Shipment delays raise cutoff risk. Following up connects the supervisor's comments to potential misstatements in revenue. A gap policy label is not enough. You must still evaluate implementation and appropriateness. This shows the danger of insufficient follow-up. New tech can help, but the auditor must evaluate whether it's working as intended. That's relevance and reliability of evidence. The big picture? Auditors don't stop at surface-level answers. They probe, corroborate, and connect responses back to financial statement assertions and risks. Think of it this way. Interviewing management without follow-up is like speed dating. Everyone sounds great in 30 seconds, but unless you ask the real questions, you don't know what you're getting into. On the CPA exam, if you see an answer that basically says, management said it's fine, so I moved on, that's the trap. Don't just nod. Ask the next question. Next question. While testing the operating effectiveness of the client's control requiring manager approval of all purchase orders over $50,000, the auditor selected a sample of 40 transactions. In 3 cases, evidence of manager approval was missing. Which conclusion is most appropriate? Statement 1. The deviation rate is 7.5%, 3 divided by 40, which the auditor must compare to the tolerable deviation rate to evaluate control effectiveness. The deviation rate is 7.5%, 3 divided by 40, which we compare to the tolerable deviation rate. Yes, that's the correct way to approach testing. Attribute sampling for controls means we look at the observed deviation rate and compare it to what we said was tolerable in planning. Statement 2. A few missing approvals do not mean the control failed entirely. The auditor must analyze whether the exceptions indicate a control deficiency or a more severe deficiency. A few missing approvals don't mean the control is completely ineffective. Correct. We need to analyze whether these exceptions point to a simple deficiency, a significant deficiency, or something bigger. Professional judgment is key here. Statement 3. Because exceptions were found, the control is not operating effectively and the auditor must conclude a material weakness exists. Because we found exceptions, we must conclude it's a material weakness? No, that's way too extreme. Not every exception equals a material weakness. It depends on the deviation rate, the control's importance, and the risk of misstatement. Statement 4. If the tolerable deviation rate was set at 5%, the observed deviation rate exceeding this threshold indicates the control may not be relied upon for the audit of financial statements. If tolerable deviation was 5% and we observed 7.5%, that suggests we can't rely on the control. Yes, exceeding the tolerable rate means we can't depend on this control to reduce substantive testing. It doesn't automatically mean material weakness, but it does affect audit reliance. So the correct conclusions are statements 1, 2, and 4. That makes the right answer option C. This maps directly to the blueprint task. Perform tests of operating effectiveness of internal controls, including the analysis of exceptions to identify deficiencies in an audit of financial statements or an audit of internal control. Testing operating effectiveness. We tested whether approvals over $50,000 were consistently present. Deviations show the control didn't always operate as designed. Deviation rate analysis. The observed 7.5% deviation rate must be compared to the tolerable deviation rate set during planning. This is how we measure control reliability. Exception analysis. Exceptions don't automatically equal failure. The auditor must evaluate whether they represent a control deficiency, a significant deficiency, or a material weakness under AUC 265/AS 2201. Audit reliance. If the observed deviation rate exceeds tolerable deviation, we can't rely on the control for audit evidence. That means we'll need more substantive procedures to cover the risk. Judgment. The auditor must exercise professional judgment to classify the deficiency and decide the audit response. This is the heart of control testing. You don't just count exceptions, you analyze what they mean for reliability and audit strategy. So here's the bottom line. Finding a few exceptions doesn't mean the sky is falling, But if the deviation rate is above tolerable, that control isn't making the team roster this season. And calling every exception a material weakness, that's like declaring a power outage every time the lights flicker. On exam day, remember, measure, compare, analyze, conclude. That's the auditor's control testing playbook. All right, next question. An auditor tests a sample of 60 sales invoices for occurrence and cutoff. 2 exceptions are found. One invoice was recorded in December, but shipping occurred January 3. One invoice for $20,000 had no supporting shipping document. Which response is most appropriate? Statement 1. The auditor should project the exceptions to the population to estimate potential misstatement and evaluate against materiality. Yes, that's exactly what AUC 530 requires. Project sample misstatements to the full population, and then evaluate the results in light of tolerable misstatement and performance materiality. Even if you only see 2 errors, you still have to consider what they mean at the population level. Statement 2. The auditor should investigate whether exceptions are isolated errors or part of a broader issue. Absolutely. That's the professional skepticism piece. 2 errors might just be flukes, or they could signal a systemic problem. The auditor can't just assume. You've got to follow up. Statement 3. Because 2 errors were found, the auditor must conclude revenue is materially misstated and propose an adjustment. No, this is too extreme. Finding 2 errors in a sample of 60 doesn't automatically equal material misstatement. The auditor has to project, evaluate sampling risk, and compare against materiality before drawing conclusions. Statement 4. The auditor should consider whether more procedures are needed to determine if cutoff or occurrence assertions are broadly affected. Yes, this is the right next step. If you see cutoff and occurrence problems in your sample, you expand or refine testing to see if the issue is bigger than just a sample. So the best set of statements is 1, 2, and 4. That makes the correct answer option C. This links directly to the representative task. Perform tests of details, including the analysis of exceptions, to identify potential misstatements in an audit of financial statements. Here's the breakdown. Performing tests of details. The auditor selected a sample of sales invoices and tested occurrence and cutoff, 2 critical revenue assertions. Analyzing exceptions. Both errors found are relevant. One indicates a cutoff issue, recorded in the wrong period, and the other raises an occurrence issue, no support for a recorded sale. Projecting misstatements. AUC 530 requires extrapolating from sample results to estimate possible misstatement in the entire population. That's statement 1. Investigating nature and cause. Exceptions must be analyzed to determine if they are isolated or systemic. That's statement 2. Expanding or refining procedures. Based on the errors, the auditor considers whether additional testing is needed to assess cutoff and occurrence assertions across the population. That's statement 4. Avoiding overreaction. The standards never say 2 errors equal material misstatement. Instead, auditors use projection, materiality, and judgment. So here's the moral. 2 bad invoices don't mean the whole revenue cycle is rotten, but they do mean you need to dig deeper. Think of it like finding 2 burnt cookies in a batch of 60. Maybe it's just those 2, or maybe the oven's off. Either way, you don't throw out the whole bakery, but you definitely test more before serving it to guests. And on exam day, if you see an answer that says must always conclude material misstatement, treat it like the burnt cookie. Set it aside, it's not the right choice.